Hi everybody, it's Peter Schiff. It is Saturday, August 20th, 2011. It's now been 2 weeks since my last video blog, and of course 2 weeks since S&P courageously downgraded U.S. government debt. My only criticism is what took them so long, and I don't think they downgraded far enough. But a lot has happened in the markets in the last 2 weeks, and I want to kind of recap what's been going on. But of course, I have been giving day-to-day commentary on the markets, on the downgrade, on my radio show at schiffradio.com. So if you're not making a point to tune in every day, if you want more frequent updates, that's what I suggest you do. Just go to schiffradio.com. You can listen live, or you can become a premium member and you can listen to the show at your leisure on the website. Also, a lot of people who watch this video blog subscribe from my corporate website, Europac.net, and you only get notified when I officially up. We also put a lot of highlights from the radio show up on the YouTube channel. So if you want to listen to some of the condensed versions, what you should do is go directly to my YouTube channel at Schiff Report on YouTube and subscribe there as well. If you do that, you will be notified of all the new content that comes on my video blog. So you do that directly at Schiff Report, or it's a yellow tab. You click it, it's right on the top. Or next to any of my YouTube videos on YouTube, there's a subscribe button. And if you hit that, then you'll be notified and you'll get more frequent updates than what I've been able to do on this video blog. But anyway, over the last 2 weeks, we've had a lot of action in the market. First of all, the Dow Jones dropped better than 600 points, or 5.5% during this 2-week time period. The NASDAQ fared even worse. The NASDAQ was down 7.5%. But here's the crazy part. The yield on the 10-year U.S. Treasury dropped from about 2.56 to about 2.07 during those 2 weeks. And in fact, at one point this week, the yield, I think it was yesterday, Thursday, or not Friday, Thursday, the yield actually dropped below 2%. It got down to like 1.9 something. That's the lowest it's been in my lifetime. I'm not really sure how far back you have to go to get to a yield that low. But, so think about this. People were so nervous that the S&P downgraded U.S. Treasuries that they sold stocks in a big way. And what did they do with the money? They bought U.S. Treasuries. Now think about that. The U.S. Treasury market is seen as a safe haven from the U.S. Treasury market. How crazy is that? I mean, talk about going from the sublime to the ridiculous. I think maybe this is going to mark the end of the dollar or U.S. Treasuries being a safe haven, because obviously they can't be a safe haven from themselves. And I think it's going to dawn on people that the real safe haven is gold. Gold gained better than 11% during these 2 weeks. It's over $1,800 an ounce. In fact, the Dow gold ratio dropped below 6 to 1. This is a new low for this bear market that began in 2000 when the ratio was 43 to 1. So I think that the dumb money maybe is moving into treasuries, but the smart money is moving into gold. And I think pretty soon the people who are buying treasuries are going to realize just how foolish that decision is, and that there is no safety in treasuries. Maybe they'll have the Wile E. Coyote moment where they look down and realize that they're not standing on firm ground, and that is the case in treasuries. I mean, when you're selling stocks and buying treasuries, really you're jumping out of the frying pan into the fire. And I think more and more people are going to buy gold. Also the dollar did not rally in the last 2 weeks. In fact, the dollar index dropped by about 1%. And the amazing thing is the dollar lost ground against the euro. Despite all of the problems in Europe over the last 2 weeks, the euro did not lose value against the dollar. Now, it lost value against gold, and it would have lost a lot of value against the Swiss franc if it wasn't for massive intervention and even speculation for a while that the Swiss would actually peg their currency to the euro. What a mistake that would be. They would be committing the same mistake as the Chinese, pegging their currency to the dollar. But still, a lot of intervention. kept the euro from dropping against the Swiss franc and the dollar. And of course, the dollar did hit an all-time record low on Friday against the Japanese yen. But believe me, the dollar would be a lot weaker against the yen were it not for intervention and continuous talk of intervention coming out of Japan. So even though people flocked into treasuries, they didn't buy the dollar. Now look at gold stocks. The Huey index was up 10% during the last 2 weeks. I mean, I think it should be up a lot more given an 11% rise in the price of gold. But the fact of the matter is, gold stocks were up. They didn't follow the NASDAQ and the S&P down. Now contrast that to what happened when global markets were panicking back in 2008. Back then, gold stocks underperformed. They went down more than the overall stock market. Now they went up. In fact, in 2008, when they were buying treasuries, they were dumping gold. Gold went down. Now gold is being embraced. Gold is rising. And of course, in 2008, the dollar index surged as stocks plunged. The opposite. The dollar actually lost some value. It didn't collapse, but it didn't go up. And what this shows to me is there is a change going on, a change in perception. And contrary to what people who are saying, people are looking at the gold market and saying, well, gold is not reacting to inflation because there is no inflation. It's just being a safe haven. Yeah, a safe haven from what? It's a safe haven from inflation. That's where the safety comes from. People are getting into the dollar, into gold because they want out of dollars. They want out of euros. They want out of yen because they fear inflation. In fact, we got CPI numbers this week that show, even by the government's measure, consumer prices are up 3.6% year on year. That's big. That's almost 4%. Remember, Nixon imposed wage and price controls when inflation got to 4%. Here it is 3.6%. Of course, if we still measured inflation the way we did under Richard Nixon, we're probably at 10%, if not more. Yet everybody is saying there is no inflation, and they're thinking that gold is rising for some other reason. Again, I heard a lot of talk over the weekend about a gold bubble. Remember, we've been hearing that talk for years and years. Google, I wrote a column, the top 10 signs of a gold bubble, I think back in 2004 or 2005. It's kind of funny, but if you read it, you can find it on the internet. But here's an interesting fact. 3 years ago, at the peak of the gold market, just before the financial collapse of 2008, gold hit a high of about 1,000. Since then, it's up 80% in the last 3 years. During that same period of time, gold stocks are up just 10%. 10%, that's it. What kind of bubble is this if there isn't even enough enthusiasm about the gold market that people don't want to buy gold stocks? After all, they own gold. They have gold in the ground. They have huge reserves. They're mining gold. They're profiting from gold. The fact of the matter is, gold stocks, or the lack of interest in gold stocks, shows that there is far more fear in the gold market than greed. And that is not a bubble. That is the antithesis of a bubble. Now, getting back to the S&P downgrade, of course, the talk about shoot the messenger. They machine gunned the messenger. Everybody was all over S&P for the fact that, hey, they missed the subprime crisis. Well, so did Fitch, so did Moody's. So why should we believe they're AAA? They were just as complicit as S&P, and of course those criticizing S&P for missing the subprime crisis themselves missed the subprime crisis, but also the administration attacked their math. They said S&P was off by like 2 trillion. Well, the administration's math is wrong. Everybody's math. The assumptions on growth, on inflation, on unemployment, on interest rates are all farcical. Both S&P and the administration are way underestimating exactly how bad the budget deficits are going to be over this 10-year period. And of course, what's happening now? S&P is being investigated by the Justice Department now, by the SEC. Of course, the government claims that, this investigation started before the downgrade. Of course, it was there to intimidate S&P. They were saying, hey, we're investigating you, so make sure not to downgrade us. And now that they've done it, they're escalating the investigation. Notice how Fitch or Moody's isn't being investigated. They did the same thing with subprime. So this whole thing is a sham. People should be able to see through it. But I think the biggest problem over the last 2 weeks was the Federal Reserve's reaction. Ben Bernanke coming to the rescue with the Bernanke put back on August 10th as the market was imploding, assuring the market and the world that the Fed was going to keep interest rates at zero for the next 2 years. 2 years at least. The problem with the U.S. economy is that interest rates are too low. And by keeping them at zero, we're going to exacerbate those problems. The only way we can really restructure the economy and have real economic growth, real higher standards of living and employment gains, is if we allow interest rates to rise. But the Fed can't do that without toppling the housing market, bankrupting the federal government, collapsing all the financial institutions. So instead it tries to maintain this phony recovery, a phony bubble economy. Of course, we got more economic data coming out about that. Last week we found out that the June trade deficit was the highest it's been in 3 years. It jumped to $53 billion. So despite all of the supposed recovery, and everybody's been talking about, oh, it's going to be an export-driven recovery. Well, where is that? The trade deficit is at a 3-year high as the dollar is falling. The dollar just hit record lows, I said, against the Japanese yen this week, hit a record low against the Swiss franc. It's relatively low. The dollar index is historically low. Why isn't our trade balance improving? After all, that's what the experts are saying, because you don't increase your competitiveness by debasing your currency. We've got real-world examples of that. And, despite this, you still have countries like Switzerland and Japan acting as if a strengthening currency is a crisis and as if they have to do something to prevent it. The crisis isn't when you have a strong currency, it's when you have a weak currency. See, anybody can have a weak currency, just print money. That's all you have to do. But having a strong currency means you have a vibrant economy. It means you're productive. And it means you have a credible, independent central bank that doesn't bow down to politicians. One of the crazy things that's really going on right now, and it is kind of like out of a Twilight Zone episode, is that you are getting criticism of the Federal Reserve from the public, not from the administration. And I heard the administration saying, or some of the presidential candidates who say, look, we can't criticize the Fed. We need an independent Fed. And if we politicize the Fed, we get all kinds of problems. Yes, but normally when you have politicians criticizing the Fed, they're criticizing them for being too tight, for taking the punch bowl away. That's where the criticism comes from. But the problem is the people who are criticizing the Fed are criticizing them for being too loose. See, that normally doesn't happen. But we don't really have an independent Federal Reserve. We don't have the independent Fed chairman, Ben Bernanke. He is acting in concert, in cooperation. Why should the government criticize the Federal Reserve? The Fed is doing exactly what they want, which is monetizing their debt, which is spiking the punch bowl, keeping the party going. Who's going to criticize that? And the fact that some in the public are doing it, and there are some presidential candidates, Ron Paul, and of course you had Rick Perry calling Ben Bernanke a traitor, and then kind of backtracking. But I've been using that terminology for years. I was calling Alan Greenspan a traitor for years because I believe that more than any man in the country, he did more to undermine our economy, right, our system of government, our Constitution, than any single man. I don't know what you call that, if not a traitor. He was also a traitor to what he believed in, to his economic philosophy, to capitalism, to everything you can think of. And I think Ben Bernanke is simply following in his footsteps. And that is the problem. We're going to continue to try to reflate this bubble. Nobody in Washington, no one at the Fed wants to acknowledge the lunacy of this economy, that the only way that we can keep it going is with 0% interest rates. But no one wants to acknowledge all of the damage to our economy that we're getting with 0% interest rates. And they can ignore all the economic data that's been coming out all this week on the economy, on housing. They can ignore the price of gold going up. But the price of gold is like a thermometer. And if the price of gold is at 1,600, that's like having 105, 106 degree temperature. And if a doctor is going to ignore that, a doctor is going to take someone's temperature and say, hey, everything is fine, keep on doing what you're doing. Gold is telling us that it's not fine, that we are on the verge of a real crisis, of a currency crisis, and of a sovereign debt crisis. And yes, treasuries may have rallied initially. That's the knee-jerk reaction. But the real move in treasuries is going to be to collapse with the U.S. dollar and with the U.S. economy. Anyway, on that note, Take care. Oh, and don't forget, if you haven't looked at my new report, go to goldripoffs.com and read my report on precious metal scams and send it to your friends, because a lot of people are buying precious metals. We want to make sure that the people who are doing it don't get ripped off. Take care, everybody. Have a great weekend.